Hello everyone, my name is Stephen Fox. Welcome to my channel. Well, we've had an outstanding rally in artificial intelligence since the beginning of the year. Since the beginning of the year, for example, super microcomputer SMCI has gone up about 300%. And a year ago, from the date of this recording, it's made about 1,000%. Okay. I've been watching it since it was in the hundreds. I began investing in it in the 300s. I'm an active trader. I've been trading it off and on. And I've made all kinds of money in super microcomputer and in NVIDIA. Now, NVIDIA has been the more steady performer and hasn't required that much intervention. I've gotten stopped out sometimes, but I've gotten back in fairly rapidly. But recently, it's starting to get as volatile as super microcomputer, and that's of concern. And I got stopped out on both of them on Friday. The market was weird on Friday. It went up high in the morning to begin with after the jobs numbers were released, and then in the afternoon it started to crash down. And super microcomputer and NVIDIA got stopped out. I got stopped out, I think, on Broadcom and another stock. And I could see the trend where this was going, and it kept going down. And so I just bailed out of all 9 of the stocks. I think we're waiting to see what the inflation numbers are going to be next Tuesday and on Wednesday. On Tuesday, we have the CPI, the Consumer Price Index, and that is the most critical one. And it will be bad news if inflation has increased, but it'll be really bad news if it decreases dramatically. We got jobs numbers that indicate the economy is slowing. The unemployment number increased from 3.7% to 3.9%. When that number starts to go up, if you're heading into a recession, it starts to go up dramatically and quickly. And so it's really of concern that jumped 0.2 of a point. And if it continues jumps like that, if it starts to go up like 0.5% at a time, we're in real trouble. The inflation number, it will be bad if it goes up. That's not a good thing. But if it goes up slightly, the market can handle that as long as the job numbers stay good. But if both the jobs numbers and the inflation number is down, that's indicating a slowing economy. And if that inflation number comes way down, let's say it drops down, be ridiculous, I'll say it drops down to 1%. Okay, that indicates the economy's crashing and there's no support for the continued stock rally. I don't want to be in the market at that point, and I may become a bear and decide to look at my triple inverse funds. But until that happens, I think I'm going to play it cautiously. The best thing is for inflation to go down a little bit at a time. That's very hard to do. If the stock market were being run by the pilot of an aircraft, it'd be like the pilot saying to you, hey, we're having a landing and we're going to land, but it's going to be a real hard landing. But you don't want it to come down too fast. You want to land that plane nice and smooth. This rally has been excellent for me and for the 9 stocks that I follow. I've made $530,000 since the beginning of the year. Okay, I've learned to trade. After 40 years, I've gotten the hang of it. And now that I've been able to devote full time to it and concentrate on it and watch it every second, I'm doing extremely well. I will accept the $500,000. I made about $500,000 when the market went down with triple inverse funds. In 21, I made about $900,000. Half of that, $500,000 of that was due to Tesla, and the general market was just skyrocketing, and I made $900,000 in 21. Needless to say, retirement has been very good to me. My 3 years of retirement have made me unimaginable amounts of money to devote my full energy to trading. When you're a clinical psychologist, you're devoted to your patients and having them have good outcomes, and you're a viewer of other people's lives and trying to help them figure out where they need to go. Stocks, much less complicated. Learn things from my previous trading over the years. I always did some individual stocks. I mostly did ETFs and mutual funds simply because I didn't have the time to devote to it decently. And now that I have the time, it's been very profitable. I've noticed that some writers now are starting to focus more on the artificial intelligence stocks. Some people are talking about the terrific trio, and that, of course, would be NVIDIA and super microcomputer. And they also include Taiwan Semiconductor, which is TSM. And I have nothing against TSM, and I think their theory is right. If China doesn't invade, they are going to do gangbusters because they manufacture most of the semiconductor chip. It's that nagging worry that China could invade that keeps me away from TSM. It keeps Warren Buffett away, so I guess I'm in good company. What I've given you is 9 fine stocks. I followed super microcomputer for some years now. The others I've brought into the mix as they seem to be percolating up. And I think it's a good mix of stocks. General question is, what is the general market going to do? And how is that going to affect artificial intelligence stocks? I think artificial intelligence stocks, the long-term trend, I don't think is in doubt. It is such a dramatic trend, and it's not a theory. It's bursting forward right now. This is the difference between now and the dot-com revolution at the turn of the millennium. Back then, that was all theory. It was things that were going to be produced. Artificial intelligence is here right now, and we're going to get to the point where we have general artificial intelligence, and that's going to be out of this world in its effect on the entire society. But we do have to contend with the market fluctuations. There isn't a better example of this than super microcomputer. I mean, I've tried to stick with it and hold on to that stock. It almost won't allow you to do that. And especially lately, it jumps from 800 to 1200, and it can do it in 1 or 2 days. It's just unbelievable. If you're making good gains, this is really fun. But all of a sudden it has a 20% drop. Whoa. And, I tried to expand that to 8%, but 8% is enough. I get stopped out on that. I've gone back to doing a 4% stop loss on SMCI. And what I'm doing is I'm trading smaller lot. I used to buy 300 shares. So let's say at $1,100, that's $330,000. Wow. Okay. I think I decided 100 shares is enough. That's $110,000 at that point, and I can trade it multiple times. I have enough ammunition to be able to do that. And I get out when it starts to go down. I still just have a 4% stop loss. Because when it starts to go down, if it goes down 4%, it's probably going to go down 10%. That's the way the stock acts. So I'll take the 4% loss, wait for it to bottom at some point, hope I timed the upswing right. And I've been lucky so far doing this. And this is part of the reason that I've made $530,000 since the beginning of 2024. The long-term trend with super microcomputer is not in doubt. There's plenty of demand for their business. There is concern about their having a $1.7 billion bond offering. It's a convertible bond, and it's likely that the bondholders at some point will convert their bonds into stock, which will dilute your shares. Okay, that's kind of a negative on the one hand. On the other hand, they're using that $1.7 billion to invest more in their infrastructure, which will make them able to produce more servers, for example, and they will make more profit in that way. I view it as a good move for the company. A singular analyst is saying it could go to 1350. I don't doubt it. In the back of my mind, I think 1,500 is possible. So I'm dealing with it by just taking smaller shots at a time and hoping I'm lucky. And I've been lucky so far. And the stop loss protects me. I think stop losses are the best way of protection for me. Some people buy puts. and all this fancy stuff, and they do a butterfly. I don't know. If I did a butterfly, it'd be a way of me saying goodbye to my money. So I just try to keep it simple. All they're really doing is hedging their losses anyway. So why not just hedge it directly? You have to pay for puts in one form or another eventually. So to me, that doesn't seem like a good idea. I can see where the general trend of the market is going in the near term. Long term, I have theories like everybody else. But when you're doing options, to me, that seems very difficult to time the market exactly. I get a general sense of where the market is going and go with it, and I can change that sense at any time. With an option, you're making a prediction and you have to hold to that, and to me it just seems way riskier, and so I don't do it. I try to keep it simple. And looking at the year-to-date chart on SMCI, you get some idea that, there's moments when this stock goes down, it's kind of a rough ride. This conceals what it's like to actually trade it during the day. During the day, you can go down and up 100 points at a time. And when that happens, if you have just 100 shares, let's say, that's $10,000. It's at 71 for a relative strength, and it's not overbought simply because it's shakes investors out because they get sick of these stomach churning drops. The upswings are great. They're exhilarating. But this is like being on a roller coaster where the highs keep getting higher, but you have these downdrafts to the point where you're wondering what's waiting at the end of the track, and you're hoping it's not an oncoming train. NVIDIA has been a leader of the stock market. In my mind, it is the stock market right now, in my mind, because I'm focused on these 9 artificial intelligence stocks that are pure plays. The mega caps like Meta and Amazon, they use artificial intelligence and it's involved, but they're not pure plays on artificial intelligence. The 9 stocks I'm giving you are pure plays, and that's why I think the future is so bright with them. But what's of concern with NVIDIA on Friday, when the stock market ran into a wall, is that NVIDIA is starting to act like super microcomputer. It came down almost 100 points from $973 to about $875. Oh no, is this like infectious disease? I hope not. The interesting thing with NVIDIA is that its relative strength is 33. You mean to tell me at these price levels that it's underbought? That's what the relative strength would indicate. If the general economy comes down, these stocks will come down to an extent, but I believe they'll come down less than the rest of the market. And the reason is because there is such a demand for artificial intelligence, and that's not going anywhere, and it's not theoretical. It's very real, and it's in our faces right now. An example is Broadcom. Their profits from artificial intelligence increased from about 7 billion to about 10 billion. Okay, and their semiconductor business is doing well too, but to a lesser extent. And you will see different people give you a positive view and say, hey, they're selling their semiconductor chips and they're doing great on artificial intelligence and everything is just wonderful. And then there's other people that say, yeah, their artificial intelligence business is better, but the semiconductor chip business is falling off. The general sense of the general economy is starting to go down with these jobs numbers. Broadcom came down significantly on Friday. I think it came down like 7%. But again, my stop loss of 4% saved me again. My A team is Broadcom, which is AVGO, Advanced Micro Devices, which is AMD, and ASML, which is a Dutch company which provides such a vital service, especially for artificial intelligence. And as we look at the chart, you can see they all had a significant falling off on Friday. And thankfully, my stop loss saved me once again. Many times with a stop loss, especially one of 4%, It works best when the stock market shoots up suddenly, like it did on Friday morning, and then goes down significantly in the afternoon. And that's exactly what happened with all these stocks. And especially as we look at the chart on Vertiv Holdings, VRT, and Insight Enterprises and SIT. You can see, especially with Vertiv Holdings, it shot up and then it came down. So in reality, I lost like 1%. Okay, the stop losses saved me, and I'm very happy with my $530,000 since the beginning of the year. I was really bullish on Applied Materials, AMAT, because they are adjusting their equipment so that they can manufacture artificial intelligence chips. They've gone up 18% as you look at the chart. They've gone up 18% in the last month, while Cadence Systems, which provides the software to NVIDIA and Advanced Micro Devices to make their GPUs and CPUs. They're both very significant in artificial intelligence. I favor AMAT, but I think Cadence Systems is going to have its day since it is so vital. But at this point, these were caught in the fire on Friday, and I could see they were going down, and so I got out before my stop losses even kicked in because I could see the whole thing was going down. Now, is this going to continue? We will have to see. We get a CPI report on Tuesday, and then we get a PPI report, which is the Producer Price Index, on Wednesday, which is sort of a future predictor of what CPIs are going to be. But the Consumer Price Index, the CPI, will be more significant than the PPI, but we still want to look at the PPI on Wednesday because it tends to predict the future somewhat. The best result is if the CPI comes down somewhat, but not drastically, because if it comes down drastically, that indicates the economy is falling. Ideally, if the CPI number comes down a little bit lower, but it's got to be the Goldilocks effect. It can't be too hot. It can't be too cold. It has to be just right. This is the kind of touchy market we're in right now. You might want to hold off until things clear off a little bit. We need to get these jobs numbers. That unemployment number increasing to 3.9% from 3.7%. That's really significant. And I think it's much more reliable than the jobs numbers because they come out with these massive job numbers increases and then they always revise them down. So what is the deal with that? I think part of the problem is the jobs numbers. People can have 2 or 3 jobs, so that inflates the jobs numbers. The unemployment numbers, the jobless number of 3.9%, that's the percentage of people who have no job. They have no visible means of support. They're looking for work because they need the work and they cannot find it. And so that tends to be much more significant in my mind, and in the past is more predictive of a future downturn. That's the way I roll. I've only been doing this for 40 years, and I've been doing it intensely for the last 3 years, and I've been hugely profitable. And I hope I'm sharing information that is getting through to you. I know it's a little bit unique that I'm doing retirement funds and I can trade them endlessly without tax consequences because they're in retirement funds. So I think I'm correct on the general trend. Surely in the long-term basis and mostly in the short-term basis, I've been right too. And I'm not a perma bull. I'm not a perma bear. I'm very chameleon-like and can change on the flip of a dime. And I had to be that way, especially in 2022 when it was an intense bear market where the market changed like that too. I adapt to the circumstances and it's been very profitable. And hopefully you can glean something from my movements. Thank you.